For our case analysis, Nick and Kenny, decided to pick General Dynamics Corporation and Lockheed Martin Corporation.
General Dynamics has been around for about 60 years now. It was founded on February 21st, 1952. Their headquarters is in West Falls Church, Virginia, and they are primarily a defense and aerospace company with about 70% of their revenue coming from the first three market segments depicted here: aerospace, marine systems, and combat systems, with the remaining 30% of revenue coming from information systems and technology.
The company Lockheed Martin was founded in 1995. It was created because of a merger between Lockheed Corporation and Martin Marietta. The former was founded in 1912 and the latter was founded in 1961. Lockheed Martin's headquarters are in Bethesda, Maryland. It is primarily a defense and aerospace company with about 48% of its revenue coming from aeronautics and space systems, 20% coming from information systems and global solution, and the remaining 30% coming from electronic systems. Here you can see who owns General Dynamics. It is a largely held institution, 77.39%. There is a small amount of mutual fund ownership in 0.63%, and lastly, a relatively large portion is held by insiders, 6.95%. And here you can see Lockheed Martin shareholders. Like General Dynamics, it is largely held by institutions, 88.39%. Again, there is also a very tiny amount of mutual fund ownership, 0.56%, and a very small percent of it is owned by insiders, 0.63%. Here you see a comparison between percent ownership of the two companies. The big differences are the 11% more of Lockheed Martin is held by institutional investors than General Dynamics, and insider holding of General Dynamics is about 6% higher than Lockheed Martin. Quite possibly these could mean General Dynamics is positioned more towards a higher stock price and higher success because a large share is held by insiders.
So now, why do investors care about capital structure? The main reason investors care about capital structure is that it indirectly influences returns. It does this through quite a few ways, namely debt incentives, tax incentives, and minimizing the weighted average cost of capital. Debt is naturally cheaper financing tool than equity financing, and on top of it being naturally cheaper, companies can also deduct interest expense from taxes. Less taxes and cheaper costs of borrowing mean more profits for investors. The company will also have an optimal level of debt for the cheapest total cost of borrowing. As the company approaches its debt ratio, costs decrease, but with more debt comes more risk, such as higher probability of default and thus a higher expected bankruptcy cost. Investors will want to look to see if the company is taking on unnecessary risk or has the liquidity able to sustain higher amounts of debt. For cost of debt financing, using the 10-year Treasury bond of 1.77% as a risk-free rate, both companies have the same pre-tax cost of debt because both are rated A by Fitch. But with General Dynamics' effective tax rate of 31.30%, its after-tax cost of debt is 2.18%. Lockheed Martin's effective tax rate is 29.79%, and its after-tax cost of debt is 2.23%. Cost of equity financing was found using the capital asset pricing model. To find beta, two regression analyses and the bottom-up beta approach were used. The first regression was a 5-year regression of monthly returns, which gave a beta of 1.21. The next was a 2-year regression of weekly returns, which gave a beta of 0.92. And the bottom-up beta approach yielded a beta of 0.94. The risk-free rate again was 10-year Treasury bonds, which was 1.77%, and the market spread, as stated by Professor Aswath Damodaran from the Stern School of Business, was 5.75%. Using the three betas required, General Dynamics' cost of equity financing ranged from 8.73% to 7.06%.
The same approach was used for Lockheed Martin: one 5-year monthly regression, a 2-year weekly regression, and a bottom-up beta approach. The 5-year beta was 0.87, the 2-year beta was 0.6, and the bottom-up beta approach was 0.92. Using the capital asset pricing model again, the cost of equity for Lockheed Martin ranged from 7.06% to 5.22%. Next was the weighted average cost of capital for the two firms. Here is simply a list of inputs used to calculate using ratios and some miscellaneous financial statement data. Calculating it out, General Dynamics had a WACC of 7.87% and Lockheed Martin has a WACC of 5.33%. Lockheed Martin's cost of borrowing is significantly less than General Dynamics, about 2.5%.
The next question is then, should we change our capital structure to try to get a lower WACC? From the capital structure analysis, both companies could benefit from adding more debt. General Dynamics is currently at a debt ratio of 18.11% compared to the optimal of 90%. By increasing the debt ratio to 90%, it would decrease its WACC from 7.85% to 6.59% and increase the value of the firm from $29,926,078,936 to $35,893,084,691. Lockheed Martin's current debt ratio is 20.73 with an optimal debt ratio of 70%. By increasing it to 70%, they would lower their WACC from 5.29% to 4.79% and increase the firm's value from $37,821,635,145 to $40,761,086,084. Interest coverage ratios were also 16.53 for General Dynamics and 9.42 for Lockheed Martin. An adjusted present value analysis was also done. Here the results are fairly similar to the capital structure analysis, except here the optimal debt ratio for General Dynamics is actually 70% instead of 90%, and for Lockheed Martin the optimal debt ratio is 60% instead of 70%. So then, would a financial restructuring affect General Dynamics value? General Dynamics would of course benefit from increasing its debt ratio to 90%. However, 90% seems a little over the top. 70% sounds like a reasonable amount of debt. In the capital structure analysis, going to 90% causes it to lose its A rating and fall into an A- rating. At 70%, though, it is still an A rating. The beta also skyrockets at 90%. It reaches 7.67, but at 70% debt ratio, it only goes up to 2.82. The only thing offsetting it is that the slightly higher WACC at 70% compared to the one at 90%. It is 6.83 at 70% and 6.59 at 90%. And as for the adjusted present value analysis, 70% is the optimal point, so their firm value will be maximized in that regard, and General Dynamics is also still rated an A.
Lockheed Martin would also benefit from increasing its debt ratio to the optimal amount, but as was the case for General Dynamics, increasing debt all the way to 70% seems unnecessary. 60% was a much more reasonable number. In the capital structure analysis, 60% allows Lockheed Martin to keep an A rating, have a lower beta of 1.28 compared to the 1.63 at 70%, and only has a slightly higher WACC of 4.9% at 60% debt compared to the 4.79 at 70%. For the APV analyst, 60% was the optimal debt ratio. Firm value is maximized at that ratio in that analysis, and L&T still keeps its A rating.
Next was to check whether the stock prices were fairly valued or not. To see whether it was for General Martin, we used a price to earnings ratio and price to sales ratio comparison. In these comparisons, if the stock has a lower price-to-earnings ratio than the industry average, it is considered undervalued, but if the price-earnings ratio is higher than the industry average, it is considered overpriced. The price-to-sales comparison works in the same way. Lower than the industry average means underpriced, and higher than the industry average means overpriced. General Dynamics has a current stock price of $65.87 and a price-earnings ratio of 9.76. The industry average price-earnings ratio is 14.62, meaning it is undervalued. If General Dynamics had the same price-earnings ratio as the industry, its stock would be worth $99.71. General Dynamics price-to-sales ratio was 0.72, and the industry average was 0.9. Again, this shows that it is undervalued.
The same comparisons were used for valuing Lockheed Martin's stock price. It has a current stock price of $92.42 and a price-earnings ratio of 10.72. Against the same industry average, Lockheed Martin is also undervalued. If it had the same price-to-earnings ratio of the industry, its stock price should be at $126.04. Using the price-to-sales ratio comparison, Lockheed Martin has a price-sales ratio of 0.62. Compared against the industry of 0.9, it is again undervalued.
Based on these analyses, Lockheed Martin appears to be the better company. While it has a lower percentage of the stock held by insiders, meaning that company goals and shareholder goals can misalign, it was better in all aspects of the capital structure analysis. It has a lower weighted average cost of capital than General Dynamics and is able to achieve an even lower one from reconstructing as opposed to General Dynamics. Its cost of debt is negligibly higher, but its cost of equity is significantly lower, and its firm value is also higher. And finally, its stock price is currently shown to be undervalued along with General